Welcome back to the podcast, Yves. We're diving deeper into FX trading today, specifically with FXCM. So, we just touched on the platform's API. Can you elaborate on what a RESTful API actually means in this context? And how does it differ from other types of APIs?
Sure, Matthew. A RESTful API, in the context of FX trading, allows your automated trading strategies to interact with FXCM systems. It's basically a set of rules and guidelines that govern how your program talks to FXCM servers. Think of it as a well-defined language, where specific actions are performed through precisely worded requests. Other APIs might have different structures or methods for communication. REST is very common now because it's fairly standardized and very suitable for things like automated trading.
Got it. So, this RESTful API is crucial for building automated strategies, right? How does the Python wrapper package FXCMPY come into play?
Absolutely. FXCMPY simplifies the process. It's essentially a layer of abstraction built on top of the FXCM REST API. Instead of writing raw code to interact with the REST API endpoints, FXCMPY provides pre-built functions for common tasks. So you can use Python syntax to, let's say, retrieve historical data, place orders, or get account information, without having to deal with the complexities of the REST API itself. It makes development much faster and easier.
Right, that makes sense. You mentioned a few key functions: historical data retrieval, placing orders, and account information. Could you expand on the importance of these in algorithmic trading?
Absolutely. Historical data is vital for backtesting your strategies. You can simulate trades based on past market data to see how your algorithm would have performed in the past. Order placement, of course, is how you actually implement trades, executing them based on the signals your algorithm generates. Retrieving account information is important for monitoring your funds and ensuring that your algorithm stays within the boundaries of your account's capital.
Excellent. Now, the chunk highlights that FXCM charges fees. What types of costs should we expect, and why is this important to consider for algorithmic trading?
You're right, monsieur. It's critical to factor in these costs in your algorithmic trading strategies. The primary fee is usually a fixed amount per trade. Plus, there's the bid-ask spread. Algorithmic traders often handle hundreds or thousands of trades. So, even a small fee per trade can accumulate significantly. We should understand the pricing models. Algorithmic strategies frequently involve high-frequency trading, where the number of transactions is exceptionally high. Therefore, you need to model and account for those costs, or your profits may suffer.
This is a crucial takeaway. So, if we're building an automated trading strategy with FXCMPY, we need to be aware of those costs and account for them in the backtesting process. That's really insightful. You're highlighting the crucial importance of considering real-world market factors when developing trading strategies. So, what are the jurisdictional limitations to consider?
Precisely. Trading regulations vary globally, so availability of products can be affected. Your strategy might have to be adjusted depending on where the trader is located. For instance, the availability of certain financial products may be subject to different restrictions based on the country.
Thanks, Yves. That's really comprehensive. We'll continue this discussion in the next segment, exploring the specific features of FXCMPY and how to get started with FXCM trading in the next segment. Welcome back to the show, Yves. We're diving deeper into Python for algorithmic trading, and today we're looking at the FXCM API, specifically using the FXCMPY package. So, where do we start practically when we're trying to access this data?
Right, Matthew. First, you need to get the API working, and that starts with a free demo account on the FXCM platform. It's crucial because you'll be using that account to generate the access token. This token acts as your unique key to access the FXCM servers. We'll need that to initiate a connection with FXCMPY.
Okay, that makes sense. So, you're saying a free demo account is the critical first step?
Absolutely. It's crucial for testing and getting familiar with the API's capabilities. You don't want to mess around with live trading funds until you're comfortable with how everything works.
And what about the installation of FXCMPY itself?
You can install it using pip, just like any other Python package. The command is pip install FXCMPY. It'll download and install the necessary libraries to interact with the FXCM API.
Right? Easy enough. And what's the best way to actually connect to the API?
There are a couple of ways. The first example uses the access token directly.
Import the FXCMPY module.
Then you create a FXCMPY connection object, which we can call API. This takes the access underscore token as a parameter. Notice also we can specify the logging level, so we can have it only record important errors and not flood the output with every little thing that happens.
So, like using log underscore level equals error as a parameter for our API object. Got it?
Exactly. This makes sure the output is focused and easier to read. So you have to replace your underscore FXCM underscore up underscore token with the actual token you generate on your demo account. Crucially, you can also use a configuration file, like pyalgo.cfg instead. This makes your code more organized.
So, the config file, pyalgo.cfg, stores the information.
Right. You'd create a file called pyalgo.cfg and include the key parameters like the access underscore token and the log details there in a structured way with the relevant section headers. The key bit is that you would then use the config underscore file parameter when you create the FXCMPY connection object.
Right. So either way, it all boils down to passing the API token to the FXCMPY function?
Yes, in a clear and well-organized way, either directly in the code or through the configuration file. That ensures you're connecting to the API correctly. Important too, to note that the server parameter lets you connect to either the demo or the live FXCM server. It's a crucial distinction.
So, server equals demo connects to the demo server, and server equals real connects to the live one?
Exactly, and by default, without that parameter, it connects to the demo server. A critical point for beginners to understand, as the live server involves actual trading funds, so using the demo server is vital for practice.
Excellent. Yves, this is really helpful. Thanks for clarifying the connections and the configurations.
My pleasure, messieurs.
This is a key piece of the puzzle.
All right, Yves, we're diving deeper into data retrieval for algorithmic trading using Python. So, FXCM, right? They're offering pre-packaged historical data sets. Can you unpack what that means for us as traders?
Yeah, absolutely. Think of it like this: Matthew, FXCM, and similar platforms have a ton of raw data. Tick data, the price and timestamp for every trade. It's enormous, practically unwieldy. They've packaged this data in a manageable format. Instead of downloading massive raw files, you get compressed files. So you're downloading a summary, if you will, for euro to US dollar exchange rate for a specific week, say week 10 of 2020.
So like zip folders or archives?
Exactly. Imagine a week's worth of tick data, usually billions of rows, compressed and ready to be unpacked. This is incredibly important for speed and storage. You don't need to download all the raw data if you only want to analyze a specific period. Plus, the packages likely have metadata already included, telling you how to handle or filter the compressed data once it's on your local system.
That makes sense. So, we're avoiding the huge download and storage issues that come with raw, uncompressed data?
Exactly. It's pre-processed, ready to go. We can then use Python libraries to parse and analyze this data in a highly optimized way. It's faster and way more space efficient, which is especially important for computationally intensive tasks, like backtesting strategies.
And this applies to other data too, right? Not just FXCM service?
Absolutely. Any platform that offers historical market data, like those used for equities, commodities, or other derivatives, will likely offer these compressed data formats. It's really the industry standard. It makes sense from a data management perspective. The specific formats, the compression algorithms, etc. might differ from provider to provider, but the core concept, pre-packaged data, is universally applicable. Now, while we're downloading already compressed files, it's still going to involve considerable data manipulation with Python tools. We'll want to consider various options like data cleaning, which can be critical for any algorithmic strategies.
Excellent. You're highlighting an important point. So, to recap, these pre-packaged historical data sets are efficient and space-saving. How does this differ from the way we might retrieve data directly using an API? This is what the subsequent section explains.
Absolutely. We'll get into the API aspect in the next section, but it's fundamentally different. It involves sending specific requests to a server, which usually gives back data in a structured format, we'll need to decide what format this is and how we deal with it, like JSON or XML. This is a different approach than just downloading a pre-built archive.
Welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading, specifically how to work with historical tick data. We were just talking about retrieving data from FXCM using the FXCMPY package. Can you break down how this data retrieval process works, especially the different methods available for getting the data?
Sure, Matthew. So, we're pulling in historical tick data for currency pairs. First, we import necessary libraries like time, NumPy, pandas, datetime, and matplotlib for plotting. This is standard practice for data handling and visualization in Python.
Right, fundamental libraries. And then FXCMPY_tick_data_reader as a specific tool from FXCMPY for this. Can you elaborate on what this package gives us and what the command tdr.get_available_symbols does?
FXCMPY is a Python package dedicated to interacting with FXCM, Foreign Exchange Corporation. FXCMPY_tick_data_reader is a specific part of that package designed specifically to handle tick data retrieval. The get_available_symbols function lists the currency pairs or symbols for which historical tick data is accessible through FXCM's API using the package. This is crucial to know what data you can actually download.
Okay, so we see a list of currency pairs. Now, let's talk about retrieving a specific week's worth of euro to US dollar data. You showed code snippets for start and stop dates. Explain how those parameters influence the data acquisition process.
The start and stop variables define the time period for which you want the data. They're datetime objects, so you specify the exact start and end dates and times, crucial for pulling the data accurately from FXCM. In this case, it's a week's worth of tick data. The TDR Eurist start/stop line instantiates the FXCMPY object with the desired symbol and dates.
And what does td.get__data do?
td.get_raw_data retrieves the raw tick data itself. Importantly, the index values, the dates, are still strings in this data frame, not the datetime index format.
And the difference between get__data and get_data?
td.get_data takes the raw data and efficiently converts the index values into datetime index objects, a standardized format in pandas, making it much easier for further analysis and time-based computations. This is a significant improvement. We don't just get the data, we get it formatted for efficient analysis.
Got it. So, we got the data. Now you mentioned calculating mid-prices. How exactly does the line sub mean axis equals 1 work in that context?
Sub is the subset of the Eurist data for a specific period. Mean axis equals 1 calculates the average price for each row of the data frame, which are single data entries for the specific second. If you apply it to the bid and ask prices, that's what creates the mid price. It means you'll get the midpoint between bid and ask at each time tick.
Makes sense. And the rolling mean calculation? How do you derive a moving average of mid prices from thousands of ticks?
The sub-mid.rolling 1000 mean part calculates a moving average. The rolling 1000 part calculates the average over a window of 1000 ticks, the data entry period, effectively producing a moving average. This smoothing helps to identify general price trends instead of just focusing on individual ticks.
Perfect. So, we have a very powerful method for getting historical data and then calculating mid-prices and their moving averages, all within FXCMPY. This is super useful for algorithmic trading strategies. Thanks for explaining it in depth, Yves.
You're welcome, Monsieur.
Always happy to help.
Welcome back to the podcast, Yves. We were just discussing retrieving candles data from FXCM using Python, and now we're diving into the specifics of how to actually get that data. So, we have symbols like Eurist available. Can you explain, in layman's terms, how we get the data for a particular symbol like Eurist over a specific time frame?
Sure, Matthew. We're pulling historical data, right? So instead of just the current price tick, we're getting these candles, which are essentially summaries of price action over a specific time interval. You specify the symbol, like Eurist, and then the start and stop dates for your data range.
Okay, so we need the start and stop dates. And what does this period value mean? Like H1 for hourly data, D1 for daily?
Exactly. That's the time interval, or bar length. H1 means 1 hour, D1 is daily. There are various other options, like M1 for 1 minute, M5 for 5 minutes, and so on. So, you choose the granularity that's suitable for your analysis.
Right, so start, stop, and period are the key inputs. And how does the code actually assemble the data? Can you break down those lines from the code snippet?
Well, the key function CDR, Eurist, start, stop, period, from the FXCMPY library does the heavy lifting. It takes the symbol, start date, stop date, and period and fetches all the candle data for that criteria. It returns a candles object, and then you access the actual data with candles get_data, which gives you a pandas data frame.
So, the data variable is now a table of all this historical information. And what does the data frame look like? We see columns like bid open, bid high, bid low, bid close.
Exactly. Each row represents a candle, a time interval's price action, and the columns show the bid and ask open, high, low, and close prices. So for each time frame we get a collection of prices, allowing us to visualize and analyze price movement over time. Crucially, bid represents the price the market maker is willing to buy at, and ask the price at which they are willing to sell.
Got it. So, we have the prices. But why calculate the mid-close value?
To get a single representative price for each candle interval, we calculate the midpoint between the bid and ask close prices. This avoids the ambiguity of using either the bid or ask price alone and gives a clearer picture of price movements.
And then you're calculating simple moving averages. Why two SMAs with different lengths?
Well, different time frames give you different perspectives on the trend. A shorter moving average, e.g. 30 periods, can highlight short-term fluctuations, while a longer moving average, e.g. 100 periods, provides a broader view, smoothing out the noise and helping you to see the overall trend. Comparing these two moving averages can provide insights into trend strength and potential reversals.
So, by combining the mid-close price with these SMAs, we essentially get a concise yet comprehensive picture of the historical euro to US dollar price action using hourly data over the selected time frame. That's very insightful, Yves. Thank you for clarifying this.
You're welcome, Matthew.
Welcome back to the podcast, Yves. We're diving deeper into Python for algorithmic trading, specifically how to access historical data through the FXCM API. So, we've established that the previous methods relied on prepackaged data, but now we're connecting directly. Can you break down the crucial steps in this API connection process?
Absolutely, Matthew. Well, first, we import the FXCMPY package, which is the crucial Python library for interacting with FXCM. This line, import FXCMPY, is fundamental. It brings in the necessary tools.
Got it. And what's the significance of FXCMPY? __version__.
That's a simple way to verify you're using the correct version of the library. You know, different versions might have different functionalities or even subtle bugs. It's good practice to check the version, especially when working with third-party libraries.
Makes sense. Then, how do we actually connect to the FXCM API?
That's done with API equals FXCMPY, FXCMPY, config file equals /pyalgo.cfg. This line creates a connection object, API, to the FXCM API. The config file part is crucial. It tells Python where to find the configuration file that holds your API token. You'd need to ensure that pyalgo.cfg is correctly placed in the directory specified. The API token is essential to authenticate your access.
So it's like logging in, but programmatically?
Exactly. And pyalgo.cfg should contain the details for API connection, including your token.
Right. And what does instruments equals API.get_instruments do?
That line retrieves a list of all the tradable instruments available through the FXCM API. It's a crucial step. It tells you what you can actually trade with your API connection. And importantly, as mentioned in the chunk, this list might be more extensive than the prepackaged datasets, offering more trading opportunities.
Wow, that's a lot of instruments. Looking at the example, it lists many currency pairs, but also things like AUS 200, SPX 500, and various commodities. Is there any way to filter the list based on specific criteria, like just getting currency pairs or equities.
Absolutely. That's a great point. You could certainly filter the instruments list using Python's list comprehension or other filtering techniques to pull out specific instrument types. That's a very useful aspect of programmatic access. For example, you could filter by the presence of / in the instrument string to identify currency pairs.
Excellent. This is incredibly helpful in understanding how to access and utilize the API for algorithmic trading. Thanks, Yves.
You're welcome, Matthew. It's always a pleasure to discuss these topics.
Welcome back to the show, Yves. We're diving deeper into Python for algorithmic trading, specifically how to access historical financial data using the FXCM API. We were discussing data retrieval methods, and now we've got some practical examples. So, tell us, what's the significance of these get_candles calls?
Right, Matthew. The get_candles method is the workhorse for pulling historical data. It's a crucial function for backtesting strategies and understanding market movements over time. You see, you're not just getting raw numbers, you're getting a structured representation of price action over specific time intervals.
So, you're saying it gives us the open, close, high, low prices and maybe volume for different time frames?
Exactly. The period parameter in the get_candles method lets you specify how granular you want that data. You can get it by the minute, M1, 5 minutes, M5, 15 minutes, M15, 30 minutes, M30, and then hourly intervals, H1, H2, H3, H4, H6, H8. You can even get daily, D1, weekly, W1, and monthly, M1 data, depending on the time frame you need for analysis or strategy testing.
And the examples, like the one for euro to US dollar, how are they showing us that?
Well, the examples show you how to extract the specific price data you want. For example, the first couple of examples retrieve bid and ask data for US dollar to Japanese yen. Notice how using candles.columns for isolates the bid data, and candles.columns for isolates the corresponding ask data.
So, it's really about slicing the data frame to get the exact columns you need?
Exactly. And then you've got examples like the one that pulls a year's worth of euro to pound sterling data. There, they're setting a specific start and end date for the data fetch, which is a common way to narrow the time window. That's a crucial point for managing data volume and reducing load on the API.
That makes sense. And the output, the pandas data frame, what does it represent in terms of the data?
A pandas data frame gives a highly organized structure, like a spreadsheet. Rows represent each data point, e.g., each day's close. The columns represent specific data points like bid open, bid close, ask high, ask low, the volume of trades, and so on. The code effectively extracts the crucial information, organizes it, and makes it ready for analysis.
So, the number parameter, is that used for limiting the number of data points?
Yes, exactly. The number parameter is useful for getting a specific number of data points. It's like getting the last 10 days of data for US dollar to Japanese yen, for example. That's often very handy for getting recent information quickly.
Excellent. And we saw an example of plotting the ask-close prices. What's the purpose behind that?
Visualizing the data is incredibly valuable. Plotting the ask-close prices, as shown in Figure 9.3, provides a clear visual representation of how prices evolved over time. It helps to identify trends, patterns, and potential trading opportunities.
Great explanation, Yves. Now, is there a crucial point to remember about the historical data from FXCM?
Absolutely, Matthew. The historical data returned by the FXCM API can vary depending on the pricing model, like the bid-ask spreads. It's vital to understand how different models impact your data analysis, because that directly affects your trading strategies.
Welcome back to the show, Yves. We're diving deeper into Python for algorithmic trading, and this chunk is all about retrieving streaming data. So, Yves, can you break down the significance of streaming data in algorithmic trading?
Sure, Matthew. Streaming data is crucial. While historical data is essential for backtesting, real-time data is absolutely needed to execute and automate trading strategies in real time. You can't just rely on past data. The market is constantly changing.
Absolutely. So, the FXCM API, similar to OANDA, offers real-time data streams. How does the fpoundxcmpy package handle these streams?
The fpoundxcmpy wrapper makes it manageable. It allows you to integrate your own Python functions, these are callback functions, to process the data as it arrives. It's very flexible.
Can you explain the callback function example shown here? It looks like it's printing some data elements.
Right, the code snippet shows a simple callback function. It takes the incoming data, which is likely a dictionary, and extracts specific details like the symbol, the updated timestamp, and the bid and ask prices. Notice how it formats the output neatly, showing the data sequence. It also employs the pandas library to convert the timestamp to a datetime object for easier interpretation.
So, you're saying it's parsing the data and outputting the information in a presentable way?
Exactly. It's taking raw data, and giving you the crucial information you need to make decisions in real time. The output function is the callback. It's called every time new data arrives.
And how is this connected to the API.subscribe function?
The API subscribe function triggers the subscription to a particular instrument's real-time data stream, and the callback function, output in this case, is executed each time there's a new update.
And this happens asynchronously? Is there any blocking involved?
Yes, this processing happens asynchronously, which means it doesn't hold up the main program flow. Crucially, this is a non-blocking approach. The program continues to function while your callback function processes the data.
So, the API.get_last_price method, what's its purpose during the subscription?
While the data is streaming, API get_last_price allows you to retrieve the last available price data immediately. You can get a snapshot of the current market conditions. It's a useful tool for quick lookups during the streaming process.
Right, I see. And then you have the API.unsubscribe_market_data function.
Correct. This function unsubscribes from the real-time data stream, which is crucial for resource management and preventing unnecessary data consumption.
Great, Yves. This is super helpful in understanding how to process streaming data for algorithmic trading. What are some more complex use cases for callback functions in this context?
Well, you could use them to generate trading signals, based on complex algorithms responding to real-time market conditions. Or you could use them for monitoring specific price movements, or setting up alerts based on threshold crossings. The possibilities are practically endless. The key here is flexibility.
Welcome back to the podcast, Yves. We were just discussing how the FXCM API lets you place various order types, like market orders, limit orders, and even trailing stop-loss orders. Now we're diving deeper into the specifics of market buy and sell orders. Can you elaborate on how these API methods work and what the practical implications are for algorithmic trading strategies?
Sure, Matthew. We're talking about create_market_buy_order and create_market_sell_order. These methods are fundamental for initiating trades in the market directly. Essentially, they tell the API to execute a trade immediately at the current market price. So it doesn't wait for a specific price, it just goes through with the order based on prevailing market conditions. Crucially, this is different from limit orders, where you specify a price you want to buy or sell at. Market orders are faster, but expose you to potential price slippage, the difference between the intended price and the actual execution price.
Got it. So, in the example, API.get_open_positions is used to check the existing open positions. Why is that important?
Absolutely vital. You need to check for existing positions before placing new ones, especially in an automated trading system. Otherwise, you could end up with unintended or conflicting trades. The get_open_positions call returns an empty data frame initially. This confirms that, importantly, there are no open positions on the account.
Okay, I see how that fits in. And what does the API.create_market_order, euro to US dollar, 100, line of code do?
This line creates a market buy order for 100 lots of euro to US dollar. So you're effectively buying 100 contracts of that currency pair at the best available market price. The 100 likely represents the number of lots contracts being traded. This translates to a specific number of units, depending on the lot size defined by FXCM.
Right. And the API.get_open_positions, sell part, what's it doing exactly?
That's crucial for tracking the positions. Remember the sell variable? It's defining what details from the open positions you're interested in seeing. The cell selection efficiently extracts the trade ID, amount, currency, gross profit/loss, and buy sell status is buy. You're getting a concise summary of each open position.
So, API.create_market_sell_order, euro to US dollar, 25, reverses the previous operation and reduces the euro to US dollar position by 25 lots.
Precisely. It's a market order to sell 25 lots of euro to US dollar. You're effectively decreasing the size of your existing position. It's important to be explicit in how many lots you're buying or selling to avoid unintended large trades and errors.
Interesting. The code also highlights API.close_all_for_symbol, euro to pound sterling. This seems to close all positions for euro to pound sterling. What does this function do, and when would it be used?
That function is excellent for closing all positions related to a specific currency pair. Imagine you want to exit all positions associated with euro to pound sterling. This function does just that. This is a common strategy in algorithmic trading to manage risk and execute specific trading decisions.
Okay, and then API.close_all closes all open positions on the account, regardless of the currency pair.
Exactly. It's a blanket order to close all open positions currently held in the account, streamlining the trading process for managing open positions comprehensively. Crucially, this is different from the close_all_for_symbol method, which targets positions based on a specific currency pair.
Finally, you mentioned hedge accounts versus net accounts. Can you explain the difference and how it impacts the way orders are handled?
Absolutely. FXCM demo accounts are set up as hedge accounts by default, which means if you go long and short the same instrument, you'll have two separate positions. This is not the case in net accounts, where positions for the same instrument are netted. This has significant implications on profit and loss calculation and the overall risk assessment of the strategy.
Thanks for the insights, Yves. This was a really valuable look at how market orders work in algorithmic trading. All right, Yves, let's dive into this account information retrieval. So, we've established that the FXCM API lets us get more than just open positions, right? We can get a broader view of the account. Tell us, what's the significance of getting the default account, say, API.get_default_account?
Yeah, absolutely. Getting the default account, is really handy when you've got multiple accounts linked to your trading platform. It quickly identifies the primary account you're working with, so you don't have to loop through all of them and specify. It's a time saver, and it keeps your code more streamlined and readable.
Got it. And what about API.get_accounts? How does that differ, and what kind of information does it give us?
API.get_accounts gives us a complete picture of all accounts, not just the default one. Crucially, it provides a wealth of details for each account. Look at the output. It shows things like the account ID, the balance, the equity, the usable margin, and even daily and gross profit/loss figures. This is powerful because it's not just about the current state, but also about historical performance. You can track changes over time.
Right. So, the output, like the example out 57, tells us things like balance, equity, usable margin, right? What's the difference between usable margin and usable margin 3? Is one more important, or are they simply different measures of the same concept?
Excellent question, Monsieur.
Usable margin and usable margin 3 are, well, slightly different ways of calculating the margin available. It's often about how the API reports different margin calculations, potentially reflecting various internal FXCM parameters or reporting updates. They're related, representing different margin calculations that the platform might use, whether for internal accounting purposes or to comply with certain regulatory aspects, but they typically reflect the same underlying amount, which represents the actual amount available for trading.
Okay, so it's like different ways of calculating the same thing. That makes sense. And what about rate precision and USD Mister? What are those, and why would we care?
Rate precision is likely the number of decimal places the platform uses for pricing, like the smallest increment in the currency trade, and USD Mister, or a similar field, would probably indicate some form of USD margin requirements if needed. It depends on the details of the API and how the data is formatted. Understanding these details is very important for building accurate trading strategies, and for making sure that your calculations are consistent with the platform's. It also gives you insights into how the platform manages financial aspects of trading.
So, in essence, these functions allow us to pull out real-time account information, which is essential for our trading strategies. This goes beyond just checking current balances. We can pull out data to build more sophisticated trading strategies. Thanks, Yves.
You're welcome, Matthew. Glad to help.
All right, Yves, so we're diving deep into FXCM's RESTful API for algorithmic trading now. This chapter, based on the book, seems to be focused on the foundational API calls. Can you unpack what these fundamental building blocks are? Like, what are we actually talking about here?
Absolutely, Matthew. We're essentially looking at the core functions an algorithmic trader needs to start using the FXCM API. It's about the bread and butter of interacting with the platform programmatically. So they're covering how to set up the connection, which is crucial. You need that initial setup before you can retrieve anything else.
Right? Understanding the initial connection parameters. And then, you mentioned retrieving historical tick data. What kind of insights can you potentially glean from that?
Historical tick data gives you super granular price information. It's every single price update for a specific instrument over a specified period. So if you're trying to identify patterns in price fluctuations, you can get really detailed information. You could use it to calculate volume-weighted average prices, to understand the trading flow over time.
Okay, so for historical candlestick data, are we looking at those consolidated time-based price data points?
Exactly. Candlesticks summarize the price action within a given time frame, e.g., 1 minute, 5 minutes, 1 hour. They give you a clearer overall picture of the price movement. So with candlesticks, you might focus on identifying trend reversals or support and resistance levels.
Got it. Streaming data, real-time updates, right? Why is that important in algorithmic trading?
Absolutely crucial. Real-time data allows you to react and place orders precisely based on what's happening in the market, in real time, as opposed to relying on historical data. This is what the heart of a lot of algorithmic strategies depends upon.
And then placing market buy and sell orders? Can you explain how that ties in?
Yeah, you're actually telling the platform to execute orders immediately at the current market price. Very important for execution speed in algorithmic strategies.
In looking up account information, what would you need that for?
For monitoring your trading balance, transaction history, and potentially account limits. It's all about keeping track of your trading performance and knowing your account standing. The API calls provide a programmatic means to access all of this information.
This is a great overview, Yves. So, it seems the foundation covers core elements, connection, historical data, real-time streaming, orders, and account management. What else should we keep in mind as we delve further into this chapter?
Well, this is just the groundwork. The FXCMPY wrapper makes things easier, but knowing these fundamental API calls is key. The chapter probably also hints at more advanced aspects of the API. We'll get to them in later chapters, of course.